Ladies and gentlemen, good day and welcome to Pennar Industries Limited Q1 FY25 conference call hosted by PhillipCapital India Private Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on the date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikram Suryavanshi from the PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you. Good morning and very warm welcome to everyone. Thank you for being on the call of Pennar Industries. We are happy to have the management with us for question and answer session with the investment community. The management is represented by Mr. Aditya Rao, Vice Chairman and Managing Director, Mr. Srikant Bakkar, Chief Financial Officer, Mr. Manoj, Vice President Corporate Planning, and KM Sunil, Vice President, Investor and Media Relations. Before we start with the question and answer session, we'll have opening comments from the management. Now I hand over call to Mr. Aditya for opening comment. Over to you, sir.
Thank you. On behalf of Pennar Industries, I would like to express my sincere gratitude to all of our stakeholders who are participating in today's investor conference call for Q1. Your engagement on this call is valued and we appreciate your time and support. Our agenda today, as usual, begins with a review of our performance for the quarter. We will cover key areas such as revenue, our profit before tax, and our working capital utilization. We will also cover our strategic growth initiatives. After this, our Chief Financial Officer, Mr. Srikant Bakkar, will present his analysis of our financial results. And post that, we will open the floor up to questions from the participants in the call. So the summary of the first quarter. For the first quarter, we reported a total income of 740.89 crores and a PBT of 35.43 crores, while revenue decreased by about 2.6% compared to the same quarter last year. Our PBT increased by 20.31%. We generated a cash PAT of 42.94 crores. The decline in revenue is attributed to two primary factors. One, our strategic exit from lower margin revenue streams and slower than expected realization of new growth revenues. Our order backlogs in PEB India and PEB US have reached the highest levels they've been at. The reason for the revenue perhaps being where it is one, while we do plan for the exit out of the lower margin revenue streams, some of the PEB India and PEB US revenues we were counting on to come in the last quarter underwent a little bit of delay, primarily execution delays, including a 3-month postponement in the commissioning of our Raebareli plant, which impacted our ability to turn out revenue. And we do anticipate, however, the plant will reach its peak capacity by September. Also in the US, due to permitting delays and other operational issues, which we expect to resolve in this quarter, revenue came in lower than expected. Since these challenges are internal and not market-driven, we remain confident in our short and medium-term revenue growth prospects. Specifically, our order backlog for process equipment and hydraulics is also at peak levels and continues to grow. We've also expanded our engineering services business development teams, and we added 12 new customers in the US and in Europe. These factors collectively support our outlook for consistent revenue and profit growth. Our key growth drivers continue to be PEB US, PEB India, hydraulics, process equipment, and engineering services. So, even though the quarter came in lower, the combination of that was exit from older low margin revenue streams and newer revenue streams not growing in the timeline we had wanted to. However, these are internal issues. Our order backlogs are, as I mentioned, at their highest ever levels, over 800 crores for PEB India and over $52 million for PEB US. So, no concerns as far as our ability to scale revenue are concerned in the short term. Our PBT margin for Q1 stood at 4.83%, and this is in line with our strategic shift towards higher margin businesses As we had guided in the previous conference calls, we expect further improvements in margins in the upcoming quarters. Working capital too, there's been good improvement. As of June 30th, our working capital cycles were at 74 days. We are actively working to further optimize our current assets, especially in sectors that we are phasing out, in business units that we are phasing out, with the goal of reducing our working capital days to 72 over the next few quarters and longer term to get to 60 days. Our growth vectors, as I mentioned, primary growth drivers will continue to be PV India and US, hydraulics, process equipment. With PV India order book exceeding 800 crores and PV US again at 52 million and growing strong, we do expect that these businesses will generate a fair amount of growth next few quarters. Hydraulics also, our order books have increased to a record high, and our process equipment business is scaling well and probably will double in size compared to last year in this year. Also for hydraulics, we should probably also double in size. Engineering services continues to expand, as I mentioned, to our new customers, a growing delivery team in the US, and we've also improved our org structure to be tailored more towards both acquiring new customers and increasing per customer revenue share. So this concludes my overview of our financial performance for the quarter. I now invite Shrikant Bakhar to provide a more detailed financial analysis.
Thanks, Akshay. Welcome to the shareholders and investors on the first quarter FY25 earnings call. In terms of key metrics, revenue is at 733.45 crores from 748.89 crores. Our gross margin, there is an improvement of 184 basis points from 37.95% to 39.79%. EBITDA has reached about 10%, and it is at 10.77%, up from 9.84%. PBT, there has been increase from last quarter to this quarter. Now, the overall number is at 35.43 crores, which is up by 20.31%. And in terms of PBT percentage, that is 4.83%. So well, we are on our target to increase the PBT percentage. In terms of revenue, while I will explain in detail in terms of how on the revenue, we would tell you in terms of revenue with our continued focus to improve the margins and cutting down the sales with low margin businesses in terms of PV solar, water EPC, solar MMS, etc. You see the increase in the profitability of the business. Revenue has actually scaled up in terms of metric tons, but revenue has relatively not grown due to lower raw material prices in substrate and due to the reduced offtake for the PEB business. The diversified engineering revenue for Q1 FY25 is at 423.12 crores compared to 380.52 crores, which is up by 11.2%. The custom design building solutions, which is our PEB business, the revenue has been flatter, but good part is there was an increase in order book at India, 800 crores plus, and PEB US at 52 million. And we are confident that the revenue will go up as the year progresses. In terms of other P&L items, the other income consists of deposit income, income from mutual fund, incentives, exchange fluctuations, and collection of old receivables. Salaries is decreased due to one-time bonus which we had in the last quarter in one of our subsidiaries from 80.05 crores to 76 crores. Standalone, there was an increase by 1.45 crores from 41.32 crores from 39.87 crores. If you see the quarterly numbers, there has been increase. This is due to mainly increase of our new plant which is coming up primarily, sales resources that we have hired for our US for PV engineering, the engineering services business, and the hydraulics businesses. In terms of finance cost, consolidated Q1 FY25, it is 27.04 compared to 27.85. This is due to lower, slightly due to reduction in interest rate, while we are able to close down some of the higher interest rates loan and then taking the lower interest rate sales, and also due to reduction in sales. What we would guide to is in terms of interest to net sales as a percentage, Presently, it is at 3.69%, Q1 FY25, and Q1 FY24, it was at 3.72%. There is a reduction by 3 basis points. We expect that this has to be in the range of 3.75 by December, and our target is by March, it should reduce to 3.6 to 3.65. Depreciation, in terms of overall number, it is increased from 16.42 to 16.54 crores. Subsidiary, there is an increase on account of the new capitalizations that we are doing there by 22 lakh. In terms of standalone, there is a decrease of 10 lakh. Standalone, even with the additions, the depreciation, there is a decrease. As some of the businesses that we have exited, we are able to liquidate those assets and realize those values, based on which the overall there is a slight decrease in terms of depreciation. Tax is reduced from 25.94% to 25.49%, predominantly due to change in our sales at our US subsidiary assets. And while we guide you to note that the federal tax is 21%, and depending upon the state taxes and the place where we supply, the state taxes fluctuates. So this number, you would see a difference in terms of the overall tax rate. In terms of overall analysis, revenue has been flattish. We expect that the revenue to improve in our PEB and engineering services businesses. The profitability during the year has gone up due to better margins and change in revenue mix and standalone entities. Businesses we have exited would have added our profit and revenue higher, but this is where we are. In terms of the last point, in terms of order book, the PEB has increased and now it is at 800 crores, railway is 100 crores, and essence is at 52 million. So with this, I hand over to the moderator for taking us through the question and answer sessions of the investor community.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Naman from Chandak Investments. Please go ahead.
Hello. Hello.
Yeah, go ahead, please.
So I just wanted to know that the PEB order book which we have, 800 crores plus in India, until in how many months we can execute that?
Typically, our order books go out for about 6 months, because right now the challenge is not our order backlog, it's capacity coming online. I think this probably is closer to about 8 months.
Okay. And what are the blended margins for the PEB division?
Could you repeat that? What margin, sorry?
For PEB division, margins.
What margin? Net margin? Is that what you said?
Yes. Net margin for PEB division.
Okay. I'm not sure we give BU-wise breakup of margins, so that we will be unable to provide. But it is higher than the average margin for the company. I can guide you to that.
Okay. Thank you.
Thanks.
Thank you. Our next question is from the line of Ashish Soni from Family Office. Please go ahead.
Sir, this lower margin business, when do we think we can completely exit that?
So currently about 35% of the company is still in the lower margin businesses. So we are being methodical about slowly exiting those businesses while our revenue creeps up. And what we would like to see ideally is sustained revenue growth overall and a sustained exit from these businesses. So over the next few quarters, few years, you would see a complete exit, but for the near term, there will be a blend of new versus old.
And with this Raebareli plant, I think in your opening remarks you mentioned it will reach full utilization. So are you getting orders in hand already, or what's the situation there?
All of our PEB plants, both in India and in the US, and specifically in Raebareli as well, have completely have order backlogs which are completely in place. We just need to. We have commissioned the plant. I think trial production also is underway. I think in September we'll have much higher capacity utilization levels. I won't go so far as to say 100%, but am I audible? There's a beep on the line. I just want to be sure I'm audible.
Yeah, you are audible. And PBT margins moving up to 7%, when do you think it can achieve? Because earlier you guided, I think, 4 to 6 quarters, I think 2 quarters back. So where we stand there and PBT margins of 7% for the overall company?
Okay, so we will not be exactly able to provide you a precise timeline for us to reach 7%. What I can tell you is that our goals are to reach and exceed that number. We are currently at around 5%. Over the next few quarters or next few years, we intend to gradually scale up our margins.
Last question, this US election perspective, do you see any order book challenges in next 1 or 2 quarters in PEB especially?
So typically, we don't, because our market share in the US is so small, macroeconomic factors shouldn't impact us because we have sub 2% market share in the US in the metal building and PEB space. However, that being said, yes, the US election, there's always a little bit of a slowdown. We're not too worried about, at least medium term, we're not worried at all, but it's only a few months away, and even now I think quarter on quarter there's improvement, so I wouldn't factor in too much impact from the US election. But yes, usually when there is a little bit of uncertainty, non-residential construction activity does tend to slow down in the US a little bit. But our order backlog is, as I mentioned on my initial note, higher than it's ever been. It's growing quickly. We are expanding our addressable markets as well. Margins are stable. Operating margins are stable, so no concerns really from a macro point of view for our US business.
I think in one of the earlier conference call you alluded that you can increase your US market share. So any ambition we have, because I think 3-4 quarters back, I think you mentioned that you can increase it substantially. So I know you have been hiring a lot of sales person, if I recollect from other companies. So any update on that you want to give?
Yes, we are expanding capacity. We have substantial treasury operations in the US as well. So all of our capex growth plans are well funded, and we're quite confident of being able to scale our US business. That will take our market share up over the next few quarters and the next few years. But we don't have an aspiration to reach 10% market share, but I think we'll need to cross 5%. That by itself also means that we dramatically expand our current revenue base in the US. So that is the current phase 1 plan right now. Once we reach the higher market, let us say capacity utilization, and let us say the higher market share numbers, we'll then look at the longer term. But as of right now, yes, our market share in the US is increasing.
Okay, thanks and all the best.
Thank you. Our next question is from the line of Nilesh Shah from Arrow Investment. Please go ahead.
Hi, Mr. Aditya and Mr. Srikanth. Congratulations on a good set of numbers. If you can just give some color on the projected guideline in terms of our top line and bottom line for the year, given that we are exiting out of these non-core businesses which are low value added, and in terms of the Raebareli plant going live, if you can give us some color on the top line and the bottom line projected for the year.
Currently, the growth drivers in the business, as I mentioned, are PEB, India and US. Well, we had some teething issues in the last couple of months. These are internal capacity commissioning issues, some labor issues in terms of availability. All of those are short-term, very, very short-term, I would say. So overall, we are quite confident that revenue grows in spite of the exit of low-margin businesses. So overall for this year, I can definitely guide you to our revenue being higher than it's been last year, which would mean we will have our highest ever revenue and our highest ever profits this financial year. That we can definitely guide you.
All right. So I'm just looking at the repeat from 23 to 24 in terms of our growth. So just to get an idea in terms of 10, 15, 20% kind of growth lines in terms of numbers, if you can put in some perspective on that.
Guidance would be difficult, but I think we are looking at definitely a double-digit growth in our profitability. Yes.
Perfect. And my second question is on the land bank that we already have. I mean, we have our factories and projects over there, but given the kind of appreciation on the 500 acre plus, I think if I'm not mistaken, you can correct me, on the land bank, is there any plans of monetizing any of our land that we already own and which are not being used?
So there are several issues we are discussing in the board level. Once we have something concrete, we'll share with you. But as I mentioned the last time, there is a substantial land bank within the company, and it's a source of some strength from a balance sheet point of view, because right now not at all appearing on our balance sheet from it's at acquisition value, so it's obviously a very, very low number. But we will make plans for this, and when we have something to share, we'll share with you. As of right now, nothing to share on these issues.
Are we going to look at revaluing the assets and adding it up in our balance sheet to strengthen it up?
No, sir. When we sell, then we will record it. That's what we did with the last sale of land asset we had when we sold. But we will not be basically you're saying revalue the land assets and then bring that into the balance sheet. No, I don't think we want that.
Wish you all the very best, and thank you for clarity. Thank you so much.
Thank you.
Thank you. The next question is from the line of Chirag Jain from Yoga Capital. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. Sir, our first question is on the US PEB business. So what's the contribution of US business in the overall revenue?
From a revenue standpoint, about 25% is our US business, which we call PGR, Pennar Global.
Yeah, fair enough. So second question is we are talking about increasing the US PEB business. So what's the strategy for increasing our business? Would it be grab existing players' market share or gaining the exponential market growth over there?
Are you talking about engineering services?
Yeah.
So engineering services typically for us is structural engineering, building information, modeling, component design, and product development. All things we do in-house, but provided to our competitors and other players in the field as well. So growing well, high margin business, and the addition of our new BD team and the structuring that we have put in place both in the US and in Europe, we are seeing revenue come in, and we are planning for a substantial increase in our revenue in this field, and it will continue to be high margin.
Okay, fair enough. Sir, previously in Q4 FY24, you mentioned about mentioning that you would be doing some capex for FY25. It will be provided in Q1. So any update on that?
Our capex plans right now are fluid in the sense that we are looking at it in terms at a BU level, and our BU plans for the next 5 years are being finalized as we speak. So I will request some more time from you to explicitly share what our plan for 25 is. But we do expect to grow our hydraulics business, and we do expect that there will be capex for tubes business as well. Those are the two sectors which we will be investing into in this financial year. PEB is already done. PEB US already done for the most part, and not substantial capex there. But these two business units are what will effectively what our capex will be going to.
So do we have any ballpark number in mind currently?
I will get back to you on that.
Okay. Sure. That's all from my side, and all the best.
Thank you. Our next question is from the line of Deepak from Cypher Capital. Please go ahead.
Yeah, I'm audible, sir.
Yes, sir.
Okay, yeah. Thank you very much, sir, for this opportunity. So just one thing I wanted to check. I mean, in terms of this 35% of your revenue is in low margin business. So can you just give some details on the differential between your low margin business and high margin business? So what sort of margin we have on this 65% pie in terms of EBITDA or PBT margin, and what sort of margin we have on this 35% pie?
I think we give a broad level of guidance on that. So the lower margin businesses effectively, and let me speak from a PBT perspective, typically end up at around 2-3% from a PBT perspective. The higher margin businesses the operating margins are all high. They're above 15%, about 20%, even about 30% in some cases. As these other businesses grow, they will contribute higher and higher. So from a peak PBT percentage perspective, it can be as high as 10% or above 10% as well as a blended margin. But as of right now, they're at about 6.5%. So the blend, when you take it, is coming to about 5% right now. But we expect as the high margin increases, then the overall margin, blended margin, will keep increasing. At the peak level, it will be substantially higher than what it is today, which is at about 5%.
Understood. So and in how many quarters we are looking to completely exit the 35% pie?
That also is something I want to get back to you. It will go step by. One of the things we want to ensure is that there is no lack of growth from a revenue and profit perspective, so that in a sense controls it. There are other concerns such as while we are exiting these businesses, it's important for us to do that well enough so that our customers are well taken care of, that we don't rush through projects which take a little bit longer time, which have a longer lead time. So it may take some time, but the way we are planning this out and mapping this out is consistent revenue increase, profit increase, and margin increase. So, and over the next few years, getting to the numbers that we have indicated are our goals. So, I would guide to that being the metric. I think a hard closure date we don't currently have for completely exiting all of these businesses. That may take a little longer, but there will not be a lot of capital or any capital growth going into these businesses, so they will continue to represent a smaller and smaller portion, and over time that number will drop to zero.
So maybe 1-2 years would be a rough range. I mean, I just wanted to understand.
I think that's a frame that you can take. Yes, that's fine.
1 to 2. So when we completely exit, then automatically our PBT margin, I mean, as per current level, would come to around 6.5%, right? I mean, and there might be some improvement in that new business also. I mean, high margin business for the margin improvement scope that you mentioned about.
We would aim for a number, at least a blended margin, even in the short term, next 2-3 years, we are aiming at a number higher than 6-7%.
Okay.
6 and 7 isn't very, very far away. I mean, I think if when you have hydraulics at an operating margin of 20%, engineering services at an operating margin of about 30-35%, we don't, there is no cap. I mean, 6-7% is something we would still consider to be low from a PBT perspective.
Fair enough. I got it. I think that's it from my side. All the very best to you. Thank you so much.
Thank you. Our next question is from the line of Ashish from Growth Cypher Ventures LLP. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yes, sir.
Sir, in last Concall, you had basically given aspirations to become a $1 billion company. So my first question is, where are we on that? And second question was with respect to CapEx. My earlier participant had asked the question. We wanted to confirm what is the peak revenue expected through the CapEx which takes place in next 2 to 3 years. If you could throw some light on that, it would be really great. And congratulations for a very good set of numbers.
Thank you for your message. So let me do my best to answer those questions. Both can be considered to be guidance related. So I think how I would like to answer your question is your first question on a plan to be $1 billion. I think we have growth aspirations. Our addressable markets for the 5 major growth drivers for the company are all quite high. All of them have multiple thousands of crores in terms of revenue potential. So focusing on acquiring market share in these segments will make sure that we grow and grow well beyond $1 billion or more than that. And that's the plan that we have in the company, and we will continue to try to execute that over the next few years to get to a larger number. Right now, from a gross sales point of view, which is the metric we use, we are closer to about 4,000 crores, and we expect that to grow and scale. We will not be curtailed from growing by the market. We'll have to execute well internally, and that is what we intend to put in place. So that's from an overall growth point of view. We are not capped by $1 billion or even more than that from a revenue potential point of view. The second question you had was about peak revenue, if I understand it. So There's no such thing as a constant peak revenue. I think you will see revenue growth this year. You will see profit growth this year. I guided on a previous call to at least double-digit growth in profitability. I think that definitely is something we can commit to and we will achieve. Most importantly, our margin outlook